Today, we will talk about the basics of investing, stocks, bonds, and mutual funds. Investing is an essential aspect of personal finance and wealth creation. It involves putting money into various financial instruments with the goal of generating returns over time. Stocks, bonds, and mutual funds are three common investment options available to individuals seeking to grow their wealth. This provides a comprehensive overview of these investment vehicles, exploring their characteristics, benefits, and risks. Understanding the basics of stocks, bonds, and mutual funds is crucial for making informed investment decisions and achieving long-term financial goals. What is a stock? When an investor buys a stock, part ownership in the form of a share is bought. If the business or enterprise happens to do well, the investor benefits by seeing an increase in the value of the share. The share can either be held or sold at a profit on the stock exchange. If the business does poorly, the value of the share declines, and the investor may lose some or all of the investment. Stocks are usually riskier than bonds, as there is no guarantee that the stock will do well. However, there is potential to earn higher returns when it comes to stock trading. Companies sell their stock for various reasons, such as developing new products, expanding into new markets, or even paying off debt. The first time a company sells stock is called an initial public offering, IPO. What is a bond? Bonds are a type of investment designed to aid governments and corporations to raise money. It can be viewed as a type of loan. There is no stock ownership and dividends, but investors who purchase bonds do receive payment in the form of interest. For example, Company A needs to raise $2 million for a certain project. It decides to offer a 3-year bond to investors to raise money. The investor will then purchase the bond at the issue price, and Company A will pay the investor interest on the money paid for the bond. Once the bond matures, the company will pay the face value of the bond back to the investor. Therefore, bonds are fixed income assets, unlike stocks. The percentage of interest is fixed in advance. Bonds are rated by credit rating agencies such as Moody's and Standard & Poor's to help investors. There are broadly two types of bonds: government bonds and corporate bonds. When the government is in need of money, it can only issue bonds. Businesses issue bonds instead of seeking a loan or overdraft from the bank, as interest rates are cheaper on bonds and the bond market offers better terms. Stock versus bonds. When bonds and stocks are compared, bonds are considered to be a safer investment. It is important to note that bonds are not completely risk-free and only receive preference in case of bankruptcy. Owning a stock offers more potential for returns, but bonds come with much less downside volatility. Bond investments play a key role in balancing and reducing the short-term volatility associated with stocks. Types of investments. There are arguably endless opportunities to invest, after all. Upgrading the tires on your vehicle could be seen as an investment that enhances the usefulness and future value of the asset. Below are common types of investments in which people use to appreciate their capital. Stocks and equities. A share of stock is a piece of ownership of a public or private company. By owning stock, the investor may be entitled to dividend distributions generated from the net profit of the company. As the company becomes more successful and other investors seek to buy that company's stock, its value can also appreciate and be sold for capital gains. Bonds and fixed income securities. A bond is an investment that often demands an upfront investment, then pays a recurring amount over the life of the bond. Then, when the bond matures, the investor receives the capital invested into the bond back. Similar to debt, bond investments are a mechanism for certain entities to raise money. Many government entities and companies issue bonds. Then, investors can contribute capital to earn a yield. Index funds and mutual funds. Instead of selecting each individual company to invest in, index funds, mutual funds, and other types of funds often aggregate specific investments to craft one investment vehicle. For example, an investor can buy shares of a single mutual fund that holds ownership of small-cap, emerging market companies instead of having to research and select each company on its own. Mutual funds are actively managed by a firm. while index funds are often passively managed. This means that the investment professionals overseeing the mutual fund are trying to beat a specific benchmark, while index funds often attempt to simply copy or imitate a benchmark. For this reason, mutual funds may be a more expensive fund to invest in compared to more passive-style funds. Real estate. Real estate investments are often broadly defined as investments in physical, tangible spaces that can be utilized. Land can be built on, office buildings can be occupied, warehouses can store inventory, and residential properties can house families. Real estate investments may encompass acquiring sites, developing sites for specific uses, or purchasing ready-to-occupy operating sites. In some contexts, real estate may broadly encompass certain types of investments that may yield commodities. For example, an investor can invest in farmland, in addition to reaping the reward of land value appreciation. The investment earns a return based on the crop yield and operating income. Commodities. Commodities are often raw materials such as agriculture, energy, or metals. Investors can choose to invest in actual tangible commodities, or can choose alternative investment products that represent digital ownership. Commodities can be an investment because they are often used as inputs to society. Consider oil, gas, or other forms of energy. During periods of economic growth, companies often have greater energy needs to ship more products or manufacture additional goods. In addition, consumers may have greater demand for energy due to travel. In this example, the price of commodities fluctuates and may yield a profit for an investor. Cryptocurrency. Cryptocurrency is a blockchain-based currency used to transact or hold digital value. Cryptocurrency companies can issue coins or tokens that may appreciate in value. These tokens can be used to transact with or pay fees to transact using specific networks. In addition to capital appreciation, cryptocurrency can be staked on a blockchain. This means that when investors agree to lock their tokens on a network to help validate transactions, these investors will be rewarded with additional tokens. In addition, cryptocurrency has given rise to decentralized finance, a digital branch of finance that enables users to loan, leverage, or alternatively utilize currency. Collectibles. A less traditional form of investing, collecting, or purchasing collectibles involves acquiring rare items in anticipation of those items becoming in higher demand, ranging from sports memorabilia to comic books. These physical items often require substantial physical preservation, especially considering that older items usually carry a higher value. The concept behind collectibles is no different than other forms of investing, such as equities. Both predict that the popularity of something will increase in the future. For example, a current artist may not be popular, but changes in global trends, styles, and market interest. However, their art may become more valuable in time should the general population take a stronger interest in their work. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.